Did early financial panics precede the Great Depression? Have you ever wondered how past financial troubles shaped the economy we know today? The answer lies in several significant financial panics that occurred before the Great Depression. These earlier events revealed weaknesses in the banking and financial systems, setting the stage for the crisis of the 1930s. Starting in the early 19th century, the United States faced multiple financial panics. One of the first was the Panic of 1837. This crisis was triggered by a collapse in land prices and led to widespread bank failures. The aftermath was a deep recession that highlighted the fragility of the banking system and the urgent need for stronger financial regulations. Fast forward to the Panic of 1873, often referred to as the beginning of the Long Depression. This panic was caused by overspeculation in railroads and the collapse of a major banking firm. The effects were severe, leading to a prolonged economic downturn, high unemployment, and financial distress that spread across both the United States and Europe. As we moved into the late 19th and early 20th centuries, especially during the Gilded Age, the United States experienced several more banking panics. Notable years include 1884, 1890, 1893, and 1907. These panics often started in specific regions but quickly spread nationwide due to interconnected banking relationships. Bank runs forced institutions to sell assets rapidly, which caused asset prices to plummet and threatened the solvency of many banks. These financial crises revealed key weaknesses in the financial system. There was no central authority to provide liquidity during crises, leaving banks vulnerable to sudden withdrawals. The repeated crises contributed to the establishment of the Federal Reserve System in 1913. This system was designed to stabilize the banking sector and prevent future panics. Despite these reforms, the Great Depression, which began in 1929, was preceded by financial instability and smaller panics. However, the scale and duration of the Great Depression were unprecedented. Earlier panics provided historical examples of how financial markets and banking institutions could fail, but the Great Depression was far more severe due to a combination of stock market collapse, banking failures, and economic contraction. From the perspective of stock market history, these early panics illustrate the cyclical nature of financial markets. They highlight the risks associated with speculative bubbles, inadequate regulation, and fragile banking structures. Financial crises can ripple through the economy, affecting industries, employment, and public confidence. Understanding these early financial panics helps to contextualize the Great Depression as part of a broader pattern of financial instability in United States history. It emphasizes the importance of financial market oversight, central banking functions, and sound economic policy in maintaining stability.